The next little bit of complexity that we have to add to transactions are discounts. And discounts are really not that difficult. They can throw people off, especially when they've already got sales taxes in the transaction. And we get into merchandise where you also have to deal with the merchandise at the same time you deal with the sale. It can get a bit confusing, but discounts shouldn't be what throws you off if you remember these few simple rules. All right, we're going to go over them. And before we do that, though, let's just talk about why they exist at all. If you realize that when somebody owes you money, right, so you have an accounts receivable, that represents your money in the hands of someone else, which of course you can't spend. So to encourage people to pay in a more timely basis, in other words, to help out that accounts receivable turnover number, right, to get your hands on your money faster, some companies will offer a discount if you pay early or if you pay within very little of the time period you give, right? Because you usually have 30 days, so that maybe if they pay in 10, you'll give them 1 or 2% off, right? That's how that works. So without further ado, let's look at our 4 rules. So the first rule is that, and this will make more sense when you see a couple of journal entries. So rule number 1, you can only have a discount when cash changes hands. Now, if you think about that, that makes sense because you don't know if the person or the business has paid in the discount period you've offered until they actually pay. So until cash changes hands, there's no discount to record. So the source document might actually give terms for a discount, but you're not going to pay any attention to it until they go to actually pay. So obviously, if the sale was for cash, you deal with the discount rate then at the time. But if it was on credit, you don't worry about the discount in the journal entry. So 2, the discount always appears on the same side as cash. Right? This is the part that throws people. They don't know what side is it, debit or credit. Well, it's always on the same side as cash because instead of cash, you're accepting less cash for the discount. So whatever the debits that were supposed to go in cash now have to go somewhere else, but they're going to be on the same side. They're going to be debits. Or if you're paying and you're getting a sales discount, then the credits that you would have put in the cash account for paying aren't going to be there. They got to go somewhere else. So they go into a sales discount account, right? You're accepting, for example, on a sale from a customer, you are accepting less cash for the discount. So the discount's got to be on the same side as cash because you're swapping the value for cash to the value for discount. 3, because that's all you're doing, the discount then only affects cash. It doesn't affect any taxes. It doesn't affect any other accounts at all. Just the cash value. And remember, it only ever happens when cash changes hands. So it's just the cash account that's affected, and discounts are always on the same side, debit or credit, as cash. Right? And that goes for both types. There will be 2 types of discounts: sales discounts and purchase discounts. And these rules apply to all of them. Okay? The last rule is my rule. Discounts are always calculated on the total amount owing because I said so. Now, this isn't always true, but the real rules are much too complicated. It's often true, though. But in this course, with me, discounts will always be calculated on the total amount that is owing. So in other words, if you owe $1,000 and the discount is 1%, right, and that 1,000 is with all the taxes and everything included, then you calculate your 1% discount on the total amount owing, including taxes and everything. That's how we do every transaction in this course so that we don't get confused. Okay, so to do this, there's now 2 more Contra accounts. Now, you learned about Contra accounts for the first time when you learned about sales taxes in the last lesson. So they are accounts that are sort of married with another account, and they act in the opposite manner. So purchase discounts is a Contra expense because it lowers the cost of something, right, that you bought. You're getting a discount off of what you were supposed to pay. So it's a Contra expense. It reduces expense. Sales discounts is a Contra revenue, right? So instead of the money that your customer was supposed to give you, you give them a discount and they pay you a bit less, so that lowers your revenue. So it's a Contra revenue account. Just to show you, here's where they are. Their sales, for example, or some kind of revenue. Sales discounts has the opposite effect. So revenues are credits, so a sales discount would be a debit. its normal balance is debit. And likewise down here where we have purchases for expenses are debits. So purchase discounts is a contra expense, but it has normally a credit balance. Let's do it. One last thing. Terms that you would see on a source document look like this. And that looks like some wonky alien language. I understand that, but it's very easy to read it. The way it's read is simply you get 2% off. So you read it like this. 2 in 10, net 30. But what that means is you get 2% off if you pay within 10 days. And you have a net grand total of 30 days to pay without any interest penalty or otherwise, right? So you get 30 days on your accounts payable or whatever, accounts receivable to pay. But if you pay within 10, you get 2% off the total amount owing in this course. Got it? So let's do a quick example. So let's say we have a transaction worth $1,000 bought on account and the terms are 2 in 10, net 30. How would we do this? So on the left, we're going to look at the buyer. On the right, the seller. So here, when you buy, you're going to have a purchase discount. So here's our first one. So on January 10th, we buy supplies of $1,000. We owe $1,000. That's all we record because remember, money's not changing hands. We just record the terms, done. The seller for the same transaction would record accounts receivable for that $1,000. Notice we're ignoring sales taxes just to keep it straightforward for a minute. And that seller would credit revenue of $1,000. Now, when the payment came on January 18th, 8 days later, now the terms were 2 and 10, so the 18th is 8 days. So that's within the discount period, so the 2% is going to come off. So to clear out this accounts payable that we owe, the buyer is going to debit accounts payable for the full $1,000 and normally would send $1,000 to their supplier, but because they're going to take advantage of the terms, they are going to send 2% less. So they credit cash for 2% less, which is $980. And this is where rule number 1 comes from. The discount is only affected when you pay, and it's where rule number 2 comes from. That because now you're going to pay less cash, those missing credits have to go on the same side. So the discount, which is a purchase discount, has to be on the same side as cash. And that's what it looks like. So we credit purchase discounts, a contra expense, to offset the expense of whatever this item was. I guess it was supplies. It'll eventually be supplies expense. That's the journal entry. So the seller journalizes something similar. So they're going to receive cash of $980. And they're going to credit the accounts receivable. But first, they have to take a sales reduction by recording the sales discount. Because instead of $1,000, they accepted $980. So that 20 in debits is missing. It's got to go into the sales discount. So the discounts, whether they're sales discounts or purchase discounts, they go on the same side as cash. Doesn't matter when, where, or how. They're always on the same side. And then they'll credit their accounts receivable to wipe out what's owed. And that's how you record a discount. The only thing you might want to look over again is if on January 10th, the transaction was not on account, it was for cash. And the only thing that would change is that instead of accounts payable or accounts receivable, it would be cash, but not the full amount because they're paying cash immediately, which is certainly within the 10-day discount period. So it would look like this. You'd buy your supplies, you'd pay cash less the discount, and you'd have to credit purchase discounts because you're purchasing. And the sales revenue would have been $1,000 cash, but there's going to be a discount. So it's 2% less. It's $980. And that missing 20 goes into sales discounts because it's the sale for the seller. And they credit revenue for the full amount charged, even though they don't get the full amount. That's how it works.